Hi, everyone. So nice to see you all today. Thank you for joining us. I know I just started the broadcast, so I'm going to give everyone a chance to actually get online. My name is Erica Diegnan-Minahan from 1,000 Angels, and I am thrilled to have such a wonderful audience with us today to talk a little bit about your startup investing goals for 2020. And we have a lot to dig into today. I'm really excited. I know you guys are excited about thinking about how you will build your portfolio over the next decade. And I know, Eric, you just sort of went on mute, but before we dig into everything, I do want to let you guys know that we have a fantastic guest broadcaster with us today, the CEO of Alto IRA, Eric Satz. So Eric, hi, how are you doing today?
I am fantastic, Erica. Great to be with you, and thanks for including me. Really excited about the audience and the discussion of the 2020 investment goal topic.
Yeah, well, we're really thrilled to have you with us as well, so that our listeners can learn a little bit more about how making private equity investments through a self-directed alternative asset vehicle with retirement account funds can be beneficial to them. So I'm going to let you kind of come on at the end to tell them a little bit more and answer any questions they might have. So we'll get back to you in a bit. Thank you, Eric. All right, great. Well, it looks like we've got quite a few folks on the line already. And I am going to very quickly, hold on, get started. Oops, there we go. Now we've got the right thing. Sharing my screen with the presentation for today's session. Sorry, that was last week's session that popped up there really quickly. And so this month's topic is the 2020s, right? So what are your startup investing goals for a new decade? And how can we really think about how to build a portfolio that is going to help create value for you in the long term? And a new decade is a great time for folks to be sort of thinking about their portfolio goals as far as startup investing goes, just because technically, the duration of these assets very often ends up being about 7 to 10 years. So I love for people to really be able to sort of take the long-term view. You know, a lot of folks are sitting back right now, thinking back to 2010, thinking, geez, I wish I'd invested in, you know, X, Y, or Z company. You know, I would have really benefited from it. So we want to think about, okay, now it's 2020, you know, what do we want to be sitting back thinking about our portfolio when it's 2030, right? And so adding startup equity can really be transformative in you ending the decade thrilled or maybe with some regrets. So just to tell you a little bit about myself, for those of you who don't already know me, my name is Erica Diegnan-Minahan. I am founder and managing partner of 1,000 Angels. I've actually been investing in seed and Series A stage private equity venture capital for over 14 years, which is pretty exciting. As we said, it's a long-term asset class, so it takes a really long time to get experience and get good at this. But for 8 years prior to that, I was actually a traditional investment banker working with public market securities and public companies as an investment banker at firms like Solomon Smith Barney and Credit Suisse First Boston. I'm also a member of the GP for 2 venture capital funds. One is Dream It Fund 2, and then also my own venture fund, Rain Ventures. And during the last 14 years, I've had the good fortune to invest in well over 100 early stage companies and to work with probably thousands of early stage founders. I did my MBA at Columbia Business School and my undergrad at UCLA. So go Bruins. So we all know that the last decade was really good for a lot of early stage technology investors. We've seen, you know, just recently the acquisition of amazing fintech company Plaid that is getting acquired by Visa for over $5 billion. Last quarter, we saw the announcement of PayPal's acquisition of Honey for $4 billion. We've seen companies like Ring and Glassdoor get acquired over the last decade for, over $1 billion. And, most folks are quite aware of the incredible opportunity that lies in the private market. So these are companies that never even had the chance to go public. If you were just investing in the public markets, you never even had a chance to invest in them. And they can provide really amazing returns for investors that are willing to come in at the early stage. So how can you get some of the equity of these types of opportunities into your portfolio to help juice your returns on investment for the next decade? So we know that the 2010s were great, but there is still just as much potential for truly outsized returns in early stage tech over the next decade. And positioning yourself to take advantage of that is really crucial to being able to outperform the market. So first, we want to talk a little bit about the sectors that we love for the 2020s. And we're not sector-focused investors here at 1,000 Angels, but we do notice some themes that we love to, we want to sort of get on those rocket ships because, as a certain sector or market opportunity is really well poised for growth, it makes sense to, get on board. Rising tide lifts all boats, that kind of thing. So we'll talk a little bit about some of the sectors that we're really excited about and that we think are poised for significant growth during the next decade. So here are 3 sectors that we are confident have multi-billion-dollar growth potential. And these might be sectors that you're kind of already thinking about and that you might notice might be a little bit more difficult to take a position on in some of the public market companies because they're really sort of about innovation and about, companies that are just starting. So the first is, of course, fintech. Now, fintech has been amazing in the 2000s in general, right? And so there are a few reasons why fintech is so attractive to startup investors just in general across the board. So number one, these companies have a tendency, and actually Alto IRA is kind of one of those, right? You guys just did a round as well, I know. So you fit in this category of the attractive fintech companies.
We like to think we're attractive, yes.
Yeah. And it's just one of those sectors. If you're starting a company in fintech, it's just number one going to be a little bit easier for you to raise money versus, for example, somebody who's doing something in consumer or biotech or, anything that has to do with brick and mortar. It just has really sort of good bones for early stage investors. And a big part of that is because usually these companies are highly capital efficient. So capital efficiency is really attractive when you're coming in early stage is because number one, dilution is minimized. And number two, if the founders don't need to constantly be raising, hundreds, billions of dollars in capital, they can actually focus on growth and not fundraising. And we'll look at some examples of really great companies that have gotten to multi-billion-dollar exits on less than $50 million in total capital raised. And that's sort of like an ideal situation. Number two is that they're almost always touching a transaction. So the closer you are to actual money, the easier it is for the firm or the startup to actually capture value. So that's another big benefit that fintech companies have. And then number three, it's just where investment is happening in huge amounts over the next 10 years. So the big banks are just hampered by regulation. They're slow to innovate. They don't really have sort of the amazing, innovative technology experts that a startup might have on board to really be able to create, amazing, magical new product very nimbly. So there's a ton of room there for startups, and over $30 billion is going to be invested in the next few years just to improve and automate financial services, even in really simple ways. And because that core technology is, or the ability to create that core technology is rarely in-house, a lot of that money will be spent on acquiring IP of valuable startups in the sector. A second one that we love is video. So you guys are probably familiar with the TikTok takeover, right? Everyone, all of the, I don't know, Gen Zs and younger are on TikTok all the time. And, it's really seeping into all of the other media platforms that are out there. So video is just becoming a crucially essential component in every communication, right? If you think about Instagram, which is a pretty dominant platform right now, we went from uploading a picture and making a little post to now, I have friends who are managing, small brands, and they're posting, maybe 10 pieces of video content every single day. LinkedIn is going with LinkedIn Live. Video is just starting to dominate every single platform. And it's only going to become more and more important as now there are highest quality screens in every hand. Brands have to create new perishable video content nearly daily. So technology that makes it easier for them to do that is going to be very valuable. Social video is just everything. So video is new. So this sort of like this new omnipotent format that we're using for all communication. So whether it's brands communicating with clients or even just, friend communicating with friend, husband communicating with wife, it's really dominating our personal communication. And because it can be time consuming, there's really going to be opportunities for startups that can solve the paradox of choice. So people will need to be able to cut through the abundance of video content and make better consumption decisions, just like Google was able to help us sort through all of the noise on the web. There's going to be great opportunity for companies that can actually analyze all of this video data and help brands and consumers of content connect more efficiently and improve consumption decisions. A third one that we're really excited about that, people have been talking about for a long time, but it looks like the day is finally here for these companies to really take off, is of course, Internet of Things. So, we've been hearing about Internet of Things for ages. Obviously, there are a tremendous number of companies, that have started internet enabling everything. Ring is one of the ones that we just had used as an example of a company that was acquired recently. And basically with the advent of 5G and just, connectivity everywhere, there's going to be much better adoption. But more importantly, artificial intelligence and developments in artificial intelligence are really going to turbocharge the value of Internet of Things. So, it's one thing to kind of track all of your information or track all of the information that's generated by a specific device or wearable or whatever it is, but you really need to be able to analyze and make that data valuable. And in order to do that in real time, you need some pretty advanced artificial intelligence to be constantly parsing these vast quantities of data. So as we have more developments in AI, the data will be able to actually be used to provide real-time solutions for problems in all areas of life. And of course, that real-time advantage is key to making IoT as valuable as it's going to be over the next decade to help increase efficiency and productivity really across all sectors. So it's a great play, great technology, and we're looking at for companies in this space. So we've had a few ideas about what we can possibly invest in. And of course, there are lots of amazing new innovations in technology that we can invest in over the next decade. But really what's very important for you to understand as you're building your portfolio strategy is to understand kind of how you should invest, right? And what are some of the smartest ways to get sort of the best bang for your buck. And, before we go into the next session, I do want to just really quickly remind everybody that we love to keep these sessions fairly interactive. I know we've got a little bit of a large group today, But there is a Q&A function as we get into sort of some of the more detail. I'd love for you guys to submit your questions, which I'm happy to answer live during the session right now and go over with you. So I think I'll get a little ping notice if anybody puts anything into the Q&A box. And if you have a problem with that, there's also the chat box as well. So I'm just going to see if I can pull up this Q&A box so it's in front of me. No, it looks like not, but if you put a question in the Q&A box, I think it'll give me a notice and I'll see your question. I'll be able to answer. So moving on to your 2020s investment strategy, what are some of the crucial things to think about developing a good one that will outperform? So let's look at a recent example of a very successful company, and that is Honey, right? The coupon, digital coupon app company that actually raised only 32, or actually no, they actually I think ended up raising about $40 million from investors and exited for around $4 billion. So that's definitely sort of hitting the criteria that we look for a great investment, a company that's able to get to a multi-billion-dollar investment on less than $50 million in capital. And so for the investors that actually participated in their $1.8 million seed round, they ended up realizing about a 300x return in the 7 years to exit. So we see some really good sort of structural data around this particular investment opportunity. One is that they were able to get to exit within about 7 years from taking their first investment. And number two, that they were able to get there on less than $50 million in total capital. So this is sort of like a perfect example of an investment opportunity in what's kind of considered could be considered a fintech company for sure. That has, you know, sort of all of the hallmarks of what is attractive to an early stage investor. So we know that seed stage investments have a long investment horizon. It's usually about 10 years. So whatever the investments that you make now are going to be providing your returns somewhere probably around the end of the decade if you're lucky. So we want to think about how we actually craft a strategy that works for long-term investing and some of the most important considerations. So if we look at this example with Honey, we know that the seed stage investors made a 300x return, but what were the other opportunities there, right? So, you know, you may or may not have gotten in, you know, sort of at the very seed round. Were there other opportunities for investors, even who did get into the seed round, to make money, and why are they important? So number one, we know Honey had a little bit of a struggle raising their seed round because they were asking for a $12 million pre-money valuation fairly early on. And a lot of investors would consider that to be a little bit on the rich side. So hold on, I know I have some Q&As, so I'm just gonna try and see really quickly if I can pull that up. Ah, there it is. Okay, I see where my Q&A box went. Okay, all right, so these are questions are a little, we'll get these towards these at the end. They're not relevant to what we're looking at right now, so I'll come back to those in a moment. We'll just continue with this example. So a $12 million pre-money valuation, some of the investors considered it, you know, a little bit on the high side, and it could be considered a little bit on the high side for an early stage company. But it's a prime example of why we do need to be diligent around valuations, but they can be, you know, a generous valuation can be a lot less problematic for investors in companies that are, number one, highly capital efficient, and number two, have what we would call binary expected outcomes, right? So binary expected outcomes means that basically you're kind of either expecting that this company is going to be, you know, get to $1 billion or more, definitely in the case of this company, or your investment's probably going to go to zero. So in that case, you know, it wouldn't kill you to invest at a little bit of a higher valuation. And those investors, they were, you know, some sort of smaller, lesser known VC funds that came into that round and actually paid the higher valuations. It did really pay off for them in the end. So in this situation, you know, they probably were less worried about it because there's less risk of dilution, which is another reason why you need to be very careful about you know, conservative valuations on early stage. And there was also plenty of upside for them should the company reach a multi-billion-dollar exit, which it eventually did. So the most important thing that we can see here is that, yes, it's great that the Series Seed investors got a 300x return, but what I want you guys to really focus on as you're crafting, you know, a 10-year portfolio strategy is that there are actually several opportunities for investors to purchase additional equity as the company grew and the risk of the investment decreased. So we can see that they did a Series Seed in about 2014. I think they were raising that, you know, actually for a little while. These things usually stay open for a while until, you know, they're full. Then they did a Series A in 2015, a Series B in 2016, a Series C in 2017, and then they had their exit in kind of like late 2019. So this is a fairly, you know, sort of typical capital raise trajectory for a fast growing fintech company, and is very similar sort of in size and timing of rounds to another really great company that we actually have had on 1,000 Angels over the last 5 years. That's already gotten to, you know, sort of a Series E. Hasn't had their acquisition yet, but has done plenty of rounds at significant increases in valuation. So the important thing to notice here is that, you know, it's not like there's one round and that's your last chance ever, right? You have to really kind of go into your investment strategy with the, you know, recognizing that the company is probably going to continue to raise money. You'll have additional opportunities to invest, and let's talk about why those can be valuable. So your chance as an investor to generate really the most value from your initial investment is to continue to participate in follow-on rounds as the company grows. So in an example like this, you know, let's say back in 2014, you had decided that you wanted to invest in the company. Now, even with hindsight, right, knowing that it's a successful exit, everything went well, you know, it'd be very unlikely that you would say, you would know that, right? You know, you can't see the future. So you wouldn't necessarily say, oh, great, I'm going to put, you know, 100 grand into this company because I love it so much. You might start off saying, okay, great, in the seed round, you know, I'll put in $25,000, you know, it's probably close to like a minimum check size investment because there's still a lot of risk in the business. And then let's say the next year, the company comes back, they do their $4 million Series A. Great, you put in another $25,000. Then by the following year, they've got even more traction. You know, they're adding, you know, they're at 50 million users, whatever it is. There's less risk in the business. They're doing a $9 million Series B. So now you can say, okay, this is a little bit of a less risky asset, right? I can put in $50,000. Then by the time they get to a Series C where, you know, the business is pretty much, you know, self-sustaining, a lot of the risk has come out of the business. You might even then want to say, okay, great, you know, I'll put another $75,000 into this round. So by the time you've actually, you know, finished sort of adding to your position, you might have, you know, close to $200,000 invested in the company. But now everything is sort of substantially de-risked. So you're kind of getting what we would describe as better value for risk as you're investing in sort of that A, B, and C stage. So the price of that you're paying for the equity is going up, but you're getting substantially better value for risk. And so somebody who had taken, you know, this type of investment strategy as a follow-on investor, an early, you know, seed stage investor who would continue to follow on in rounds, would have come out with probably somewhere around $16 million at exit on this investment. So this is a great example of, you know, the value of taking this strategy of not, you know, taking huge risk in the beginning, but being able to capture sort of that risk-adjusted reward going forward. So we use some sort of typical assumptions for follow-on round valuations for various stages of companies. So we know that this company did their Series Seed at around a $12 million pre-money. So we're kind of going to assume, based on the stage and size, they probably did their A maybe around $20 million valuation, their B probably around an $80 million valuation, and their C round probably around a $240 million valuation. So we can see that the multiple on that very first slug of capital is close to like 300x. But then even for the A round, you know, it's still 200x, right? It's still an incredibly good return. And then even for your B round, you know, you're still getting a 50x. And with your C, it's maybe down to 16x, but there's substantial risk taken out of the investment. So you can actually afford to leverage it and invest a little bit more in size. So this investor would have still come out with, you know, nearly 100x overall return on the portfolio, but by, you know, sort of matching the size of the check with the risk of the investment, they end up with a better overall investment strategy. So we just want to make sure that we understand that it's really important to make sure that when you're going into very early rounds, you want to focus on smaller investments there where there is substantial risk, and to realize that you would like to have the opportunity to possibly invest increasing amounts of capital in later rounds as the company grows, where there is more value for risk. And this chart here can kind of show you how, you know, as the company goes from seed to Series A to Series B to Series C to exit, the risk is going down, you know, at a more exponential rate than the valuation is going up. So what you're, you know, the price that you're paying for the risk of the investment becomes more attractive, I would say, mainly at usually the Series A and Series B stage. But for a high growth company, there can still be substantial value at the Series C. And that's where we love to see people adding to their positions, but with one caveat, which is that this strategy really works best for companies that are actually doing well and meeting their growth milestones. So if the company is simply, you know, run out of cash and is coming back to the trough for a bridge round without actually appreciating in value, you need to be very careful about participating in those kinds of rounds. So those are usually actually the opposite, right? So what you want to be able to do is to increase your position in investments of companies that are actually meeting their growth milestones, appreciating in value, and offering you a great risk-adjusted reward investment opportunity. So don't miss that caveat. Don't throw good money after bad. So the next question that folks very often ask is, okay, great. So I kind of understand a little bit about what is the real strategy of investing in a startup, right? So it's not just coming into that seed round, it's having a long-term view to say, great, you know, if this winning lottery ticket works out, I want to add to the position and I want to sort of ride it all the way to the top. But how much should you invest, right? And how should you think about the amounts that you want to invest? So if you're an accredited investor, it's really important to think about your long-term goals for your portfolio and how much overall you want to invest each year into startup equity. So the general rule of thumb recommendation is that you should invest between 5 and 10% of your net worth into these sort of alternative private equity assets. So it really is kind of, you know, dependent on your own situation, your own, you know, future capital needs. If you've got, you know, 3 kids that need to go to college or private school, you know, that number might be to the lower end. You know, if you're an empty nester and you don't have any financial obligations, or, you know, you're single and you know, don't have financial obligations looming, you can go a little bit to the higher end. But generally the rule of thumb is to, you know, want to be somewhere in that range over time. So if you had a net worth of say $5 million, you could probably safely accumulate a portfolio of about $500,000 in startup investments over time. And so over time is really the key part of this phrasing. It does not mean that you can put $500,000 into an investment. It means that that is your long-term sort of goal for building your portfolio. So the one thing to think about too, though, is that as your portfolio matures, certain investments might actually move out of the early stage equity asset class and into the less risky growth stage equity asset class, which can also potentially free up some of that capital allocation to allow you to make additional early stage investments. So there's, moving from, so for example, if you had, invested in Uber early stage, at some point they would have not really been a startup investment anymore. They would have been considered growth stage equity. So you might feel comfortable, moving it out of that asset class. The other more desirable way to free up some of the capital to make additional investments is, of course, if you have an exit, right? And there's liquidity and now you have cash coming in for your assets, you have a larger net worth overall. And so you can redeploy some of that back into your portfolio or to new companies. So what I would say is that, this sort of typical credit investor example that we're looking at with around $5 million in net worth might, think that, okay, maybe I'll invest in around 4 new companies a year at about $25,000 per investment. So this would result in adding about $100,000 in early stage venture assets to the portfolio annually. And, I think this is a really great example to look at because I very often, come across people who, don't have net worth of 5 million or have net worth of less than 5 million and they're still accredited, and they'll suggest to me that they want to, invest $100,000 into an individual startup, or I've even seen some crazy people put, $500,000 into an individual startup. And so I think it's really important to realize that, even if you have substantial net worth, the individual investments should really sort of stay pretty conservative until the companies have really proven that they're relatively de-risked. And because these investments are so illiquid, you can still never eliminate all the risk. And, as you guys know, back from 2008, even a really wonderful public market company, can go to zero. So, risk is never all the way gone, but it's really important to realize that, it does not benefit you to try and put large amounts into any particular early stage company. And you should feel good about yourself if you're actually sort of reining it down a little bit, particularly at the seed stage, because you'll have another opportunity. So in our example, this strategy would take this investor about 5 years to build up what we would consider a fairly well-diversified portfolio of about 20 startup investments and to get to her approximately 10% asset allocation startup. So, 20 to 30 individual companies is kind of around where you get some of the biggest benefits from diversification for this asset class. Now, diversification matters, but at the same time, you need to be incredibly careful about, what companies you're getting into, what deals you're getting into, and hopefully you have some professional guidance to help make sure that you're getting access to the right types of opportunities and that they've been extremely well diligenced as well. So assuming that the assets are good quality, a decent rule of thumb is just to invest no more than 10% of your investable net worth divided by 20 into any one particular early stage deal. So keep the numbers low. So, but remember that during that time, you're probably going to make follow-on investments in Series A, Series B, and even potentially Series C rounds of the companies that are in your portfolio. So you should hang on to what we call dry powder to be able to add to your position for companies that are doing really great and growing quickly. So just remember, you're always going to probably have the opportunity to invest more later when there is less risk. And I would say that that definitely happens in like 99.5% of scenarios. And, most importantly, just to kind of finish up on this topic is just to remember that it takes time to build a great portfolio. It really doesn't happen overnight. And as you spend more time investing and evaluating, a multitude of potential investments, your acumen and your confidence will develop as well. So those are really important. So one of the really critical things to think about as you're building your portfolio and you're figuring out, where does an early stage investment strategy sit within my overall strategy, is to really look at some of the tax considerations. And so in December, we actually did a whole webinar just on tax considerations. I'm happy to share with anybody the recording from that webinar. I'll probably just send it out to everybody as well after this, where we sort of do a deep dive into some of the amazing tax protections that this asset class can potentially have. And this is particularly where, we're going to have Eric kind of come in and answer some of your questions and chat a little bit about the opportunity there. So one of the hugest advantages to early stage investing is, of course, tax protections granted to qualified small business stock. So qualified small business stock is defined by the Internal Revenue Code. But basically it is a C corporation that has less than $50 million in assets at the time that you acquire the equity. It would be considered QSBS. And so these shares are usually subject, for the vast majority of sort of technology companies that we're investing in, not every single company. So you'd have to sort of either watch my previous webinar or go to the IRS tax code website to just get sort of all of the exceptions to the rule on that. But for the companies that do meet the criteria, you actually can avoid close to 100% of the capital gains taxes incurred when you sell a stake in the startup. So you get this exclusion on gains of up to 10 million or 10 times the basis of your investment, whichever is greater. So it's pretty generous, and it certainly only adds to the upside should you do really well on one of your investments, to know that you're going to get the gains probably 100% tax-free or largely tax-free. So that's one of the really great advantages of early stage investing. And the next one that we're going to talk about how we address is something that we call the liquidity premium. Right? So basically you receive a liquidity premium for your early stage investment, right? Given that you're not expected to be able to sell or otherwise liquidate your security for several years. So the reason why, the expected returns on these early stage investments is so high, right? Why the cost of capital can be 50% or more basically, is because there is no liquidity, right? There's no market to actually sell your equity. So there can definitely be benefits to using assets that have built-in long-term illiquidity to actually build your startup investment portfolio. And so if you already have money in a retirement account, that has built-in illiquidity. So using a self-directed IRA or 401k can be beneficial for a few reasons. So one is duration matching. Right? So you've got long-term assets in an account that is locked up for many years being invested into long-term assets that is basically also locked up for many years. And of course, liquidity matching, right? So they're completely illiquid assets that are also in an account that has a built-in illiquidity premium. And I'm just going to stop really quickly for a quick question before I let Eric take over. How does the 10%, so Derek asks, how does the 10% rule apply as the investments appreciate? Should 10% of net worth be calculated based upon invested capital only or current valuation? If you develop so I would, so this is a great question. He says, for example, if you have a portfolio of invested capital at risk 10%, but then it appreciates 20 to 50 times over 5 to 10 years, would that take up your whole 10%? So no, it wouldn't. I would think about it as your at-risk capital should not be more than 10%. So you wouldn't say, if you invested in, $25,000 in a startup, and in 2 years, it's worth $1 million, I wouldn't necessarily say, oh, that means that I can't make any more startup investment, right? I would only think about using that percentage to represent the capital that you had at risk. The other thing too is that if the value of the equity has increased by 50x, case by case basis, you also will probably want to look at it and say, is this really still startup equity? Am I really, or is this growth stage equity that's, not as risky, and I can sort of move it out of this bucket at the time. So you kind of have to look at it on a case by case basis, but, by the time a startup has appreciated by 50x, you might feel more comfortable saying, okay, to me, this doesn't really represent highly risky startup equity anymore. It represents a growth stage private equity investment. So I can sort of, move it into a different bucket and free up some of my capital. But otherwise, I would still only sort of count the capital that you actually invested as, capital you have at risk, not the paper value of it. So really, really great question, Derek. Okay, great. So just to carry on here. So a well-diversified portfolio of early stage equity can be developed in a tax efficient manner in a retirement account. So I would love to sort of hand the floor over to Eric before I then get to everybody's questions. So as he's sort of chatting with you guys, I'll have a chance to look at all the questions you've put in the Q&A, and hopefully we'll be able to answer those both together. So Eric, I have a little slide for you, but I'll let you introduce yourself and talk a little bit about Alto and how you're helping people build alternative equity asset portfolios.
Well, thanks, Erica, and I think that's a rather flattering picture of me. So I'd like to keep it. If you could send me a copy, that would be cool. So just quick background, I'm a recovering investment banker. I've also been an early stage investor managing Tennessee Community Ventures, which is actually what led me to Alto IRA and alternative asset investing using retirement funds. I knew that ERISA allowed for alternative asset investing out of your retirement savings, but it was unclear to actually how to actually execute on that capability. And so I ended up making 3 investments, what the industry refers to as self-directed IRA investments, on my own. Had a less than, let's just say, stellar experience doing that, and decided that I needed to figure out whether or not it was a big enough problem to fix, or whether I was the only one struggling with this mechanism. And so, as you know, what I found was that we had $30 trillion sitting in retirement savings accounts, less than 2% invested in alternative assets. And if you think about how professional investors, institutional investors, pensions, and endowments invest, pensions will have close to 30% invested in alternatives, and endowments will have north of 50% invested in alternatives. And yet we, the retail investors, are sitting at 2% in retirement accounts and probably closer to 5% on a global, both after-tax and pre-tax basis. And so the question was, could we build a technology platform? Bless you, I can see you sneeze.
Sorry, guys.
Can we build a technology platform that does for alternative IRA investing what TurboTax essentially did for self-filers? And so to skip to the end and then come back, I think you already hit the major highlights, which is that investing out of your IRA does 2 really important things for you: duration and liquidity matching. And then the third thing really is that savings in retirement accounts, or I should say investments in retirement accounts, accumulate tax-free. And so not only do you have the benefit of duration and liquidity, or illiquidity matching as the case may be, but you've got the benefit of tax-free compounding for higher returning, at least expected return, illiquid assets. And so, at Alto, we serve both as your custodian and as the transaction portal. That makes it easy and affordable for all individuals to invest essentially this tax advantage retirement savings into alternative assets, whether it be real estate, private equity, venture capital, credit products, commodities, art, other collectibles, could be crypto. So we have an integration with Coinbase, for example, which allows you to invest in the new form of gold or silver, I guess you could say. And we're really here to help promote access and affordability to this type of asset class and investment structure. And so that's what Alta is all about. I just want to quickly reiterate your point about diversification. We would never, first of all, we don't make investment recommendations, but we would certainly never recommend that you take all of your cash and invest it on company X, right? Because you're going to lose. Odds are just against. You really need to build a diversified portfolio, and diversified can be both diversified within the venture capital asset class, as well as diversified among a series of alternative asset classes. So venture capital, private equity, real estate, et cetera. And I think the nice thing when you look at, say, returns and volatility in private equity versus, say, the S&P 500 over the last 2 decades, is you'll see that the returns are higher in private equity and that the volatility is lower, which is probably, just the opposite of most people's expectations on both counts. So private equity has returned 14% versus 8% for the S&P 500, and the volatility in private equity has been roughly 10% versus 16% for the S&P 500. And so what including alternatives in your portfolio does, and specifically your retirement portfolio, is it adds non-correlated market returns to the portfolio and ultimately delivers a higher expected return for the portfolio overall. So I'll take a deep breath right there. And, I can go in any direction.
Yeah, absolutely. That's great. So I know we have a couple questions from the audience, but actually one of the questions that I just wanted to ask, because I don't actually know the answer to this, is can you guys do this for 529 plans as well, or is it only retirement?
So you bring up an interesting question. The short answer is yes. We can actually do this for non-retirement dollars as well. We're really focused on retirement dollars. But if you think about ERISA and the fact that this type of investment is enabled by and allowed by ERISA, the problem that people run into is that the traditional 401k and IRA administrators like Fidelity, Schwab, TD, Vanguard, E-Trade, whoever it may be, they're not going to allow you to hold alternative assets in custody with them. And there are Department of Labor and potential conflict issues and fiduciary relationship reasons as to why they won't do that. But that's exactly what creates the opportunity for us. And so to come back to answer the 529 question, actually, we currently don't have a 529 account. And so I should probably roll my answer back for a second and say, we don't currently offer the 529 investment option, but there are no reasons why we probably couldn't.
Yeah. Well, as a parent with 2 kids in college, highly recommend folks to take a look at that one.
I also have 2 kids in college.
Yeah. Hindsight is 2020. So let's get to some of the audience questions. I have one from Maya. She asked, is a regular IRA or a Roth IRA better for startup investing? She's been thinking that Roth is better, but if the startup qualifies for tax exemption, which one is better?
Yeah, so I would look, and this is all personal preference and belief in your founders and the company you're investing in. But I would stay away from investing Roth money into an early stage company and instead save that for later stage where it's de-risked. Because with Roth, you've already paid the tax, right? So part of the benefit of using an IRA in a very early stage investment is the fact that you get the free leverage of not having yet paid tax on those dollars. And the fact of the matter is, yes, there's potentially a higher reward, but it's also higher risk. Okay. And so save the Roth for the later rounds. Use the traditional IRA for the earlier rounds.
That's a very good answer. All right, great. And so we have a couple other questions here from Katie. Is there a minimum amount necessary to invest? To answer this question from the perspective of 1,000 Angels, so for investment opportunities in early stage companies that are on 1,000 Angels, investment minimums typically are anywhere between $20,000 and $50,000. And they're a little bit on the high side simply because all the investment opportunities that we do are direct investment opportunities. So you're not, part of an SPV with a bunch of other people and, getting K1s. You're actually directly on the cap table of that company. But at the end of the day, the investment minimums are completely set by the founders. So particularly in seed rounds, like anything is possible. I've certainly had folks who were permitted to do investments as low as $10,000 because, a founder was happy to have them on the cap table. So it's typically around 20 to 25, but there is some flexibility. Maya has another question. What is your opinion on healthcare and particularly digital health? So that's a great question, Maya. Early stage investors typically stay a little bit away from healthcare just because it's a really unpredictable industry, and so many of the opportunities within healthcare are incredibly capital intensive, which is not great for say the first $2 to $5 million in. That is changing though. I think we've had actually 3 health tech companies on 1,000 Angels in 2019 that were really great investment opportunities. And it's because, as you mentioned, digital health is number one, finally actually being adopted pretty, robustly by the healthcare industry. It took a while. And number two, we're kind of staying away from the wet stuff. So, things that help make facilitating clinical trials more easy, things that help make, following up with patients and, ensuring compliance easier. So, digital health products, particularly ones that don't, really sort of touch anything physical, actually are really exciting for the next decade. I'm probably never going to say they're in my top 3 sectors as I did on this presentation, but we certainly have been so much more open to it than in the past. So it's one where I think there's going to be a lot of value. We have another question from Anonymous. What framework do you use to analyze investment opportunities? So that's a very long answer. We've covered it largely in previous webinars. So I'll be sure to send folks out some of the links to our previous webinars so that you can hear the whole hour-long answer to how we dive into that. And so, wow, more questions. So we've got one from Jeff Hale who asks, and this is for Eric, can you acquire and hold Bitcoin, Ethereum, Litecoin, and other widely held cryptocurrencies in an Alto IRA?
You can. It's a great question. So with our integration with Coinbase, you can basically buy, sell, or hold any of the cryptocurrencies that are available on their platform. If you go to the altoira.com website, I think one of the 3 main visuals there, which will actually be on the right-hand side, you can join the waitlist for an Alto Crypto IRA account. We've been whittling it down pretty quickly these days. So if you join, I think you'd probably be only on the waitlist for a day or 2 at this point, which is pretty exciting for us. And the other thing I would say, Erica, if I could just go back 2 questions here in terms of what's a minimum investment requirement. for those who can't yet participate directly with 1,000 Angels on the cap table, we do work with 16 alternative asset investment platform partners. And so if you're just starting and you want to get your feet wet and you want to invest $500, $1,000, $2,000 at a time, you can come to Alto IRA, you can go to the partners page, and you can see some of those investment platform partners that we work with, which will allow you to begin to build your diversified portfolio in a way that scales with your available assets. And so I just wanted to point that out there.
That's great. Okay, so we have another question from Curran. If I withdraw from my 403B, will I be hit with taxes when I redirect to alternatives?
So the answer is no. There's a 60-day window to go from a 401k or a 403B into your own IRA. It's it's legally referred to as a rollover, and you have 60 days to complete that. And we help you with that on the Alto IRA website, and our customer success, customer experience team will help you make that happen. It's actually a relatively painless proposition.
Great. And Curran asks, at 1,000 Angels, do you handle all structuring of investment, valuation, and legal? So yes, absolutely. So for 1,000 Angels, all of our open investment opportunities are, almost 100% of the time, basically co-investments with top tier venture capital firms. So if we're doing a Series C or a Series A, the entire, term sheet has been negotiated, all of the investment docs are ready to go. So you'll know exactly what you're getting. So it'll be, okay, you're coming in on a preferred equity security at, a $12 million pre-money valuation, and the company's raising $3 million, and here are all of your investor rights. So you don't have to structure or negotiate anything. These are all sort of ready to go co-investment opportunities that you can invest in directly, so you don't need to do any of that. Valuation is already set, and we're able to make sure that you have the information that you need to be able to understand it. Derek also asks, how do you think about crowdfunding versus direct angel investing, where minimums are lower, allowing for faster diversification? Personally, obviously as founder of 1,000 Angels, I started it for a reason. I would say that the lower minimums might seem attractive, but there's very often sort of a price you're paying in terms of the quality of the assets. So, for what I've seen on some traditional crowdfunding sites, the quality of the asset is not institutional. So we're essentially only looking at venture fund led co-investment quality assets. So I wouldn't think that, having a diversified pool of sort of not institutionally structured assets, high quality assets, is not better than having, it taking longer to build up a diversified pool of higher quality venture capital assets. So that's a really great question and something to think about. The other thing that I think is really important is that, if you don't understand this asset class, just kind of jumping in with a crowdfunding platform where you don't actually have somebody who can really, very objectively kind of explain to you exactly what you're getting and the pros and the cons, and properly evaluate the risk, is very caveat emptor, right? So I would say buyer beware with some of this stuff. If you don't really have an opportunity to develop a relationship with folks that are actually evaluating the investment. So something.
Erica, do you mind if I jump in for a second?
Yeah, go ahead.
Yeah, because again, that's a really good question, and Erica's referring to something that the industry refers to as adverse selection, and the idea that people that can't raise institutionally are the ones that go to quote unquote crowdfunding platforms. And I think the good news for what I now refer to as the investment platform sector is that perception is changing and it's moving. And I think it's important to understand that the homework that's being done by the people that run these platforms is significant. And it can't be that just any company can pay to be on a platform to raise money. And just to show, kind of to give a dogs eat the dog food example, we just raised over $2 million in an angelless syndicate that had more than 200 angel investors in it. Now, we also have Foundation Capital, Amplify LA. We had the chairman of Blackstone, the chairman of, the vice chairman of Blackstone, the chairman of Jefferies. We have Tom Lee of TH Lee, Moment Ventures, Jefferson River Capital. We have a lot of institutional investors as well, which makes our story attractive to a lot of angels. And what I think I'm trying to say is that more and more companies that do have well-known institutional investors are accessing the investment platforms as a way to connect with and allow investment from the retail investor. Because if you think about what our business is, that's exactly the listener to this podcast or webinar is exactly our investor and potential customer. And so it made sense for us to raise money on that type of platform. And so to Erica's point, you've got to do your homework. You don't just, bet on 10 different numbers and hope that one hits. You still have to do your homework. You got to get smart, and you want to look at the homework that's being done by the platform providers that are bringing these assets to market. So slightly different characterization than Erica's, but I agree with her that historically, the way this industry has grown, there was the negative perception because of adverse selection. And I, for one, believe that's changing in a very positive way.
Yeah, definitely. And obviously there are great opportunities potentially everywhere. I think that the important thing, is that with these assets, they're quite unique. And so you have to have a little bit more knowledge to really understand what you're getting, right? So when you buy a public market security, it's a little bit more sort of apples to apples, whereas, these securities can be really different. And you want to make sure that, either you really understand what you're buying, or you're working with somebody who can really sort of explain to you exactly what the asset is that you're buying, and also has an understanding for the market to help advise you on how well it's structured and how well it's priced. Great. So one last question from Derek, follow up on the IRA questions. If you have QSBS funded from a traditional IRA, what's the tax treatment if it appreciates, successfully exits after 5 years? Is that growth tax sheltered or taxed as ordinary income?
So unfortunately, the answer to that question is it is not. So if you have the disposable income to invest in early stage companies that qualify for QSBS, that is a great channel to pursue. If you think about the fact that 90% of all savings in this country lives in retirement accounts, and for a whole lot of people, that's what's available to them to invest in alternative assets. Unfortunately, you get the tax-free treatment from the IRA until you distribute at retirement, but that you don't maintain the QSBS treatment in that scenario.
All right, great. Well, thank you so much, Eric. We really appreciate you joining in today and answering everyone's questions. I'm sure everyone, number one, is thrilled to learn more about alternative asset investing with retirement accounts. And also, we're really grateful that you've worked so hard building this amazing company to bring this opportunity to the masses. So thank you.
Thanks for introducing me to your customers, Erica. I really appreciate it.
Yeah, that's great. And so I loved spending time with you all today, chatting with you, answering your questions. I'll be sure to send folks who attended and registered a copy of the recording if you want to sort of go back over any of these juicy, wonderful tidbits. And if you're not yet a member of 1000 Angels, I urge you to join today, try out a free 2-week trial membership, and get started as soon as you can. 1000angels.com. If you have any questions, feel free to reach out to me, Erica at 1000angels.com, and I'm happy to set up a one-on-one call with you. And of course, we can help you also get an account set up with Alto IRA so that you can maybe start making investments out of your retirement accounts. All right, thank you. Everybody have a great day.
Bye.